We feel that now is the best time, and we certainly don't think that you've missed the boat. And you would ask any investor that has been in self-storage for a little while, and they would say that the biggest mistake they ever made was not getting into it sooner. So there is no bad time to get into self-storage.
Yeah, that's amazing, because I feel like, whoever get in first always come out big, right? If you run your business right, obviously.
Right.
Yeah. So you did answer the questions, but I felt like in the last few years, because of the attentions, the return that the storage space get, almost every mom and pop storage facilities have been scooped up by larger companies. So let's say someone looking to get started, where do they even go look for one to buy, and what size, what kind of things should they look for? I would assume that a new investor, new to the storage space, probably wouldn't go buy public storage, right?
No, you wouldn't have the ability to, first of all, and
right.
probably would be paying too much for it. There's not a whole lot of value add. Those things are optimized. But to your point, without any self-promotion, that's why we started our education company, because when we began to look out there in the landscape, there wasn't anybody teaching us the ways to market them, the ways to underwrite them, the proper ways to run them. And so, we saw an opportunity to create an education company to teach everybody what we had learned by the School of Hard Knocks and just along the way. And so the easy answer is we got to get educated, because I think it would be very simple for somebody who doesn't know about the industry or what the opportunities out there or how to market for them. They may give up and either fall prey to that line of thinking, well, I missed the boat and there's no low-hanging fruit out there anymore. But our students are buying every day, and we have a whole deal pool within our organization, in our ecosystem, where we taught a whole bunch of folks how to go out and find these facilities, and if it's too far away or too big or too small, it goes into our deal vault, and our community gets to share in those projects. And so there's plenty of opportunities out there. The REITs are building, the big boys, they're building and they're buying bigger facilities. And the regional players and the national players, they're buying some of these smaller ones, but they're buying them in groups. And so that is a strategy, and that's one that we use as well, is that you can go out and buy and find a facility on your own. That's easy. Many folks are then buying 2, 3, or 4, either to hold for their own, but the ultimate goal would be to 5, 7, 10 years down the road to then sell them to the bigger player, to the regional player, somebody in town that has another 3 or 4 and they want to buy your 3 or 4, or the national player that wants to come into that market, into your market, and they find a great way to enter is to buy the 5 facilities that you own. And that gives you the higher multiples, it gives you the lower cap rates, and just makes it easier and more profitable to sell. So the opportunities are out there. You just need to get educated. And again, that's what we're here for. That's what we do. We produce self-storage millionaires.
How do you classify a small, medium, large facility? Like, what's the number of units? Or...
that isn't a number that you would see people really looking at. People more so look at a class A, B, or C. And that usually is a function of the size of the facility as well as the market that it's in. So a Class A facility, for instance, is going to be 400 to 800, 900 units. It's going to be close to 80 to 100,000 square feet, and it's going to be in a major metropolitan statistical area within the MSA. 3 stories, climate control, all the bells and whistles, professionally run, third-party management company or a REIT. That is, what they look like when you see them. They're shiny, they're gleaming, and they are the best of the best. A Class B is, it may be multi-story, but typically it's single-story, or they may have some climate control units as well. It is paved. It could be gravel, but it's in a secondary market, so it's just outside of the MSA. It's got gates and security, and maybe there's an employee behind who's not a corporate person, but a very professional person that's dressed well and speaks well, running the facility. Maybe a little bit smaller, and maybe in that 250 unit to 400 unit range, and that would be considered a Class B facility. And then a Class C, a little bit smaller. It's going to be anywhere from, you could call it a self-storage facility, even if it has 10 units or so. It could be just one building, but typically for what we're investing in, anywhere from 50, 75 on the very, very low end on up to that 100, 150, 200 unit facility. It's in the tertiary market, so third tier markets. It may have a kiosk. It may not have anybody in the office at all. Or if it does have somebody in the office, it may be the owner, or it may be the owner's relative that isn't very well trained or very well versed in the business. It may be gravel. It may be paved. It may be dirt. It may have a fence around it and security system, or it may have none at all. It could be older, first generation, built in the 70s or 80s. Again, a Class C facility, when you see it, a Class A, it's kind of hard to determine a Class B necessarily. But that's a spectrum. We don't look so much to the size, but really the size and the quality and the market that it's located in.
So when you come across a unit, a facility, not a unit, how do you underwrite?
Well, we do multiple revisions and ways in which we underwrite them. So there's the proverbial back of the napkin math, depending upon the numbers that we have from a seller or a broker. Hopefully we have some basics. Then it's as simple as determining what the NOI is, the income minus the expenses, all in, giving you your net operating income. And then based upon whether it's a class A, B, or C facility, then apply the appropriate cap rate to it for that market and times that we're in, depending upon interest rates. Now, that's the first blush to see if you're interested and match that up against the acquisition price or the asking price. Next is if we are very serious about a facility and either we're under letter of intent or if the broker and or seller are willing to give us most of the financials of P&L for the past 12 months and a unit mix, then we can do pretty much a full underwriting on the project. And that is by way of our software. It's you could say it's fairly sophisticated. It's got about 150 or 160 different calculations, most of which we use about 20, 25. But once we include the data there, then it's just building out. It's a matter of building out our capital stack. What is our cost of capital? Are we bringing in private equity? Are we putting our own cash in? Where's the money coming from? And then what is the ROI? Does it pencil out given the income that it is producing, the net operating income, and the asking price, and then how much it's going to cost us to fund this? What is the profit on it? And is that profit enough to then bring in private equity? Is it enticing enough to give them the returns that they are seeking in the marketplace in exchange for being in second position in that equity position on the capital stack, which being just below the loan. So there's a whole lot more that goes into that, obviously, but those are the first pieces, the first steps to the underwriting process.
So can I underwrite it on a piece of napkin?
Well, I wouldn't buy it based upon that, put it that way. But you at least know whether you're interested or not on the back of a napkin. But no, we don't teach any of our students. And certainly you know that I would never condone anyone doing that.
So with that said, what do you stay away from during your underwriting process of a facility? What do you stay away from?
Well, I want to be cautious here, because the way that I buy and what we buy is going to be dramatically different from somebody that's just starting out. So for us, the goal is just as we mentioned, we would like to have institutional grade facilities that are attractive to institutional grade investors down the road. So if we're building or buying something, we certainly would like the ability to, if it's not at least 60,000 square feet right now, that we can expand and get it to 60,000. So if it's a 4-acre parcel and there's only buildings on 3 acres, if we can build that out and get it up to that place where it's 60, 70,000 square feet, that is what institutional investors are looking for. If we're going to develop a facility, it's going to be closer to the 80 to 100,000 square feet. Those are the things that we're looking for. And so when you say, what am I not looking for? It's small facilities in rural areas in those third-tier markets, because we want a bigger pool of buyers, so we're going to pay more money and we're going to get a higher yield and a higher return when we sell if we're in those second-tier markets or in the primary markets or the MSAs of the major cities. And we have to have the ability, there has to be movement in the market, meaning when people are moving, hopefully growing, the city is growing or moving in, that is a big piece for us. Rental rates have to be able to support our acquisition cost or development cost, and that usually is a function of the demand. And so there has to be demand. What is a hard stop no for us is when we evaluate in the market for a self-storage facility is really about 3 to 5 miles. For the most part, we're focusing on that 3-mile trade area. And so we're going to look at the supply index, which means the supply of competitive space, the amount of square footage of self-storage by our competitors in that market compared to our site and compared to the population. So if the equilibrium in the country right now is, depending upon what statistic you look for, is somewhere around 7 to 7.5 square feet per person or per capita. So if we're looking at a facility and we draw a 3-mile ring around it and that we see that there is 10 square feet of self-storage per person, well, we may be getting into that place where it may be oversupplied. But we'll have to look at the demand and look at the facilities to see, are they full? Are they out of units? Are they raising rates? Because there could be a higher demand in that market. Like Florida has no basements and 0 lot lines. And so 10 square foot per capita, well, that's about equilibrium for that market in a particular city. But if we look at the market, draw a 3-mile ring around a site, a facility, and we determine that there's only 4 square feet of self-storage per per person, per capita. Well, it doesn't always smell a home run, but that's exactly what we'd like to see is an undersupplied market. And then we'll go to the zoning office to see if there are any other developments that are coming. Are there any permits being pulled, any new construction coming for storage, if we're going to have new competitors? And at the same time, are there more multifamily? Are there more subdivisions? Is there residential coming in? Is there going to be growth in this market? So those are all things to consider when we're looking at a market and looking at a particular facility.